Crypto taxes are changing what every high net worth investor needs to know. If you've made money in crypto, the IRS is paying attention, and there are major tax rule changes that could impact your investments. Here's what you need to know before it's too late. Crypto taxation is evolving, and most investors are unprepared for the upcoming changes. The IRS has introduced new reporting requirements, they have stricter accounting rules, but also forms that could protect you from future audits. But you need to prepare now. Many investors are panicking, asking, what exactly do I need to report? Will this increase my tax bill? Do I need an accountant to handle all of this? The good news, it's manageable. The bad news, if you don't handle it correctly, you could face penalties, back taxes, or unnecessary IRS scrutiny. And this is especially important for high net worth investors because the more you've gained in crypto, the more the IRS wants a cut. Let's break it down exactly what changing is happening, what you need to do, and how to legally minimize your tax liability. How the IRS is tracking your crypto. The new IRS Form 1099-DA. Starting in 2026 for the 2025 tax year, crypto exchanges must report taxable transactions to both you and the IRS. Blockchain forensics. The IRS partners with analytics firms to trace all transactions, even across self-custodied wallets. Cost basis tracking. Investors must track gains and losses accurately as exchanges default to FIFO, that's first in, first out, which can increase taxable gains if not managed properly. If you thought your crypto holdings were off the grid, think again. What this means for investors. If you've been moving funds between wallets, you now need a clear record of cost basis. If you've been using offshore exchanges, your transactions may still be reported depending upon the jurisdiction. And if you've ever cashed out to fiat, the IRS already knows your holdings. The days of unregulated, tax-free crypto profits are over. Short-term versus long-term capital gains. One of the biggest tax factors is how long you hold your assets. Short-term capital gains are held less than 1 year, and they're taxed as ordinary income all the way up to 37%. Long-term capital gains are held longer than 1 year, and they're taxed either at 0%, 15%, or even 20%, and that all depends upon your income. For example, if you sell Bitcoin after 6 months with a $200,000 gain, you could pay 37%. That's $74,000 in taxes. But holding it over a year drops the rate to 20%, saving you 34 grand. Choosing the right cost basis method. FIFO is first in, first out. That's the default that the exchanges use. FIFO assumes you're selling your oldest holdings first, which can lead to higher taxable gains. LIFO is last in, first out, and HIFO is highest in, first out. LIFO uses your most recent purchases first, which can lower gains in a bull market. HIFO uses your most expensive coins first and minimizes taxable income. And you can elect different cost basis methods if you maintain proper records. Taxable income is taxed differently. Staking rewards are taxed as ordinary income when received. DeFi yields are also taxed as income even if not withdrawn. Airdrops and forks are taxed at fair market value when received. Mining rewards are taxed as ordinary income and as self-employment income if mining is run as a business. For example, say you're earning $50,000 in staking rewards at a 37% tax rate. That means you're owing $18,500 in taxes, and get this, before selling a single token. 5 legal ways to reduce crypto taxes. 1. Use tax loss harvesting. Selling underperforming assets at a loss can offset capital gains. For example, let's say you sold Bitcoin for a $50,000 gain, but you also own Ethereum that's currently $30,000 of unrealized losses. If you sell that Ethereum before year end, you can offset part of your Bitcoin gains, reducing your taxable income to just $20,000. This strategy allows investors to strategically sell assets to minimize their tax burden while rebalancing their portfolio in the meantime. 2. Invest through tax-advantaged accounts. A self-directed IRA or SD IRA allows for tax-deferred or even tax-free crypto investing. An example is, suppose you invest $100,000 in Bitcoin inside a Roth IRA. Over 5 years, your $100,000 investment grows to $500,000. Since this is inside of a Roth IRA, you can withdraw the profits tax-free in retirement as long as you follow the IRS rules. This strategy completely eliminates capital gains taxes on your crypto investments. An important point, the crypto must be held in an IRS-approved custodian in order to avoid penalties. 3. Hold for long-term capital gains. Holding for over a year lowers tax rates significantly. For example, selling $500,000 in crypto after 6 months could mean a $185,000 tax bill at the highest tax bracket. Holding for over a year reduces it to $100,000, saving you $85,000. Long-term investors benefit from reduced rates, which is why strategic holding is one of the simplest ways to lower your crypto taxes. 4. Donate crypto to charity. Donating crypto to a 501c3 lets you deduct the full market value while avoiding capital gains tax. For example, suppose you bought Ethereum for $10,000 and now it's worth $100,000. If you sell, you'll owe taxes on a $90,000 gain. But if you donate the Ethereum to a qualified charity, you get a full $100,000 charitable tax deduction, and you avoid all capital gains taxes. This is one of the best ways to reduce your taxes while making a positive impact. 5. Work with a certified planner. Crypto tax laws are constantly changing, and as you can see, mistakes can cost you tens of thousands of dollars. A planner who specializes in crypto can help you choose the best cost basis method, LIFO, FIFO, or HIFO, optimize tax loss harvesting strategies, ensure your crypto portfolio aligns with your broader wealth management plan. A proactive strategy with expert guidance can help you keep more of your crypto gains while staying IRS compliant. If you've made money in crypto, whether you realize it or not, you have a tax obligation. The worst thing you can do? Ignore it. The best thing you can do? Plan ahead and minimize your liability. You now know the key changes coming to crypto taxation, how the IRS can track your wallet, how FIFO could impact your tax bill, and why strategic planning is so critical. The next step is simple. Let's get your crypto tax strategy in place. Book a consultation with me today at Southern Incomes. We'll dive into your specific situation and ensure that you're set up for long-term success. Click the link below to schedule your free session, and let's ensure your crypto investments and tax strategy are structured to maximize your savings and your wealth protection. And don't forget to like, comment, and subscribe for more expert insights on crypto taxation and wealth building strategies. Thanks for watching, and I'll see you in the next video.